This episode is brought to you by Koifin. Koifin is one of the fastest growing platforms for financial data and analytics to research stocks and understand market trends. Imagine a Bloomberg Lite with tons of high quality equity and macro data, a powerful graph engine that can show it all clearly, and a user interface that doesn't look like it was built in the 1990s. If you're an individual investor, research analyst, portfolio manager, or financial advisor, do yourself a favor and check them out. You won't regret it. Sign up for free at koifin.com. That's KOYFIN.com.
Hit it.
It's Friday, November 26, 2021, episode 158. I'm Patrick Ceresna.
And I'm Kevin Muir. This week for Thanksgiving, we are returning to an old format. It's just Patrick and myself shooting the shit about markets, his love of moose meat, and when he might graduate from crayons to Laurentien colored pencils.
We end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We've got a great show. Lena, hop on. What beer am I drinking this week?
So I asked, full disclosure, I asked Patrick to give me a raise for having to say this beer because I don't know if I can pronounce this beer properly. Wieselberger beer, Schwarz beer?
Yes.
Like Schwarz beer?
Yeah, Wieselberger. Right? You nailed it. So it's a shout out to Patrick out in Austria who got me this beer, and I'm going to drink it here. It's very much like a Guinness themed. It's a nice dark beer, and it actually is pretty good. I like it. What are you drinking, Kev?
Oh, the Labatt Saint-Gond.
His default beer.
Just me and my boys and my Saint-Gond.
Speaking of drinking, I'm sorry. Before we go on, I owe an apology to Darius Dale because I had Whispering Angel Rosé, and it was delicious.
Here you go.
He's a listener to the show, so I bet you he's going to hear it.
I just wanted to make sure I put it out there. It was delicious.
There you go. All right.
He's a good guy, even though he does drink rosé. And you know what? I would never say that in person because he's probably like twice the size of me.
Oh, yeah.
Crushed me like a bug.
Probably.
Yeah.
Because he played football.
Yep.
Okay, let me do this.
No. We got to talk merch.
Oh, I'm sorry.
Lena.
We're all out of sorts today. So Lordo Crayons merch is now on our merch site at markethuddlemerch.com. There are some other websites that are claiming to be our official merch website, but this is the only official Market Huddle merch.
The one and the
store.
only. Boy, that's like when you know when you made it, Lena, when the people are actually trying to spoof our merch.
Apparently.
Yeah, that's nuts. And but you know what? I was like, Lena, how the hell are you gonna make me look cool on a shirt? And man, I look pretty cool as a Lord of Crayons. So it's I didn't think this was actually possible. It's
you and everyone else.
Yeah.
We were all surprised.
All right, give us a disclaimer.
Let me do the disclaimer. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the bitter Bitcoin bulimia. Bulimia. There we go. I'm having one of those troubles. One of those days, Lena. Jittery Jerome Jackups and the awkward arc sparks.
All right, let's move on.
All right, Patrick, it's time for Talking Charts.
Yeah, we're going straight to Talking Charts. This is so bizarre. But
yes, it's going to be a fun one. We got a lot to talk about.
Oh, my God.
Even though it was a Thanksgiving week and you would think that this was going to be boring, it's been anything but.
Yeah, you know what? The funny thing is just before we get to the top three, it's like it's a crapshoot because it's a low volume day. And if there was any amount of selling that comes in hard on a low volume day, it could move the market and more than it would. And so it was either going to be a completely dud day, or it could have had the pent up energy of being able to swing like this. And it was given a catalyst and it went. Right? We'll talk about the charts here in a second. But let's quickly review what we were watching last week. And we were talking about, will the Eurozone go into full lockdown? for coronavirus. And well, a few other countries started, but it depends. Like France has said that they were doing nothing, but like a couple of the smaller countries in Europe did join in and lock down fully. So it's sort of like a halfway. Like it's not fully locked down, but it's certainly not going. It's not easy.
It's going the wrong way.
It's going the wrong way. That's for sure. And obviously, this news we'll talk about in a moment. Actually, that's in our top 3. So we'll circle back to it. But buy on dip on crude, and well,
I forgot that we worded it that way.
Yeah. Answer was no. We shouldn't.
No. No, you definitely shouldn't have.
But what a monster move on crude, right? Like,
why don't we save it and we'll talk about that, because the crude's going to be an integral to the whole kind of synopsis of the market. So what was our number 1?
Well, should we buy Bitcoin?
And there we go. We top ticked it.
Well, yeah. I mean, it basically broke down and slammed almost 8% lower today, and just legitimately kept correcting. And so the no coiners are prevailing today.
The no coiners, that's right. You know how we always go down in the value of our fiat declines when Bitcoin's going up? Does that mean we're getting richer today?
Yeah, I think we are. All right, let's talk about.
It's funny because it just feels like we're going sideways. But anyways, okay. What are we watching next week, Patrick?
Kev, what do you think we need to watch next week?
Oh God, the U.S. dollar. And
yes,
I actually put this one in here.
No.
I did. I told Patrick to put this in here. It is integral to the.
You just beat me to
trade.
it.
But it's. I actually think that today was really interesting, Patrick, because we had a monster risk-off day.
Yeah.
And yet it was met with selling of the U.S. dollars.
Yeah.
And I don't know if you want to talk about that in terms of right now, or should we just put it in the full, when we're discussing the entire market?
Yeah.
But I think that when a market does something that it's not supposed to, I sit up and take notice, and I did sit up and take notice.
It seemed like in this iteration of this correction was anything and everything that was working in one direction reversed. It didn't matter about the intermarket correlations or what you naturally think. The dollar was going up, and everyone started getting on.
Well, it's because everyone got long very quickly as the dollar went up.
And so I just think that this was whatever.
It's just a shakeout across the board.
It's right across the board.
Any of the short-term trends that had been in place were reversed. Is that what your argument is?
Exactly.
Well, that's not the worst argument you've ever made.
Number 2, Fed Chair Powell testifies. And so there's multiple days that he's in front of the House Banking Committee, and whenever he's being grilled, it's always going to be interesting to see if he says something that is the market pays attention to and reacts to. But obviously, this coronavirus thing will now suddenly be much more relevant. I'm wondering whether Powell's testimony becomes just second headline news.
Well, one of the things I'll tell you, Patrick, I've been saying for the past couple of weeks that we've experienced peak inflation hysteria.
Yeah.
And even though I'm an inflationist and believe that inflation is going up over the long run, the amount of, that financial doom website that you love and other kind of, let's just say, market strategists that are prone to hyperbole were talking about how this is just getting out of control, yada, yada, yada. We had Jack Dorsey talking about hyperinflation was upon us. It just felt to me that it was anyone and everyone had heard about inflation. That was the number one worry. And whenever something is the number one worry, I stop worrying about it.
Right.
I tweeted out to one of my pals the other day. I gave him the Bank of America does this client survey for institutional clients, and they show the number one concern and throughout the years.
Right.
And they'll go through. And so it was like Donald Trump trade wars was, I don't know, 15 weeks in a row, and then it went to COVID, and then it went to inflation. And I said that anytime that is the number one worry, you can stop worrying about it, especially when it's been
because
there
it's been
for a few weeks.
it's because it's been baked into the cake.
Yeah,
Right. Like there has to be there has to be a next level move in inflation in order for the market to have to now reprice something in addition, like this.
So back to the Fed Chair Powell testifying next week. A lot of people thought he would come and he would be very hawkish to counteract the inflationary moves that we had been seeing and all the rhetoric in the Larry Summers of the world and Mohammed El-Arian screaming that they've made a policy error, blah, 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 blah. And now all of a sudden the Fed looks like, with the oil giving up, how much were we down today? $10 or some crazy number. It doesn't look like it's as needed. And not only that, Patrick, the Fed has shown that it is more sensitive to COVID lockdown / developments than probably the market is.
Yeah.
So one of the things that I think you should watch for next week is, will the Fed push back on the amount of tightening that was in the market? We already saw it. The June euro dollars for 2022 had a big rally today. And even the farther dated ones rallied. And I think that that'll probably be the surprise, is that Powell comes and he doesn't end up being as hawkish as everyone thinks. And who knows, maybe that's what the dollar was sussing out and anticipating for next week.
Yeah. It's going to be interesting to see. And so number one, and I think this is the biggest one, is like, are the variant fears now overblown? Like, this reaction was huge. But the thing is that we've gone through how many waves of COVID, and it goes over and over again. The question is that can the market just like deja vu suddenly, like no one saw this coming? Like the fact that there's going to be an infinite number of variants in the COVID strain. It's going to be nonstop. It mutates perpetually. Like, so how many times is the market going to react that there's a mutation when mutations are guaranteed?
Well, Patrick, I would argue that this had more to do with positioning than this actual development. And if people hadn't been over their skis extra too long, and hadn't been pushing all their trades, then this news would have been handled a lot better. I was confused because when I read the headline that I got up this morning and saw what everyone was getting upset about, we'd actually heard that yesterday during the day. And I think we might have even heard it the day before. I'm not exactly sure, but it was definitely yesterday. And so the European markets and the S&P 500 in terms of the Globex, they've had lots of chance to react. But for some reason, everyone decided that this was the time to react. And it just started to snowball on itself. What if
it's just? I would like to offer the alternative view, which is the fact that the market was way overdue for a market correction, but
that's what I'm saying, Patrick. Too many people were long.
And then when the market started to correct, the media needs to grab onto something to justify why it's happening. And so it just so happened that this headline was there, and they therefore say market is down because ... But the market was down just because everyone was getting hammered on their stop losses, and they were just suddenly the selling kind of created a chain reaction liquidity event, right? Like it's
you are another one that I have trouble arguing with you about.
All right, well then there
you go.
Let's talk
so much
charts.
Wisdom from you.
Let's talk some charts then, buddy. All right, so let's start off here. Just a look at the SPY and that S&P 500 drop, right? I think that's like we're just going to go in order of just the markets. We have lots of time in today's show just to kind of cover so many different things. But like this, the interesting part is that if you look at the entire year, there was market correction after market correction. On average, a rally would last about a month, and then you would have some sort of 3-day market correction that basically returned back to its 50-day moving average, was immediately bought on dip, and then resumed its rally. And we were going on for well over a month on this rally higher without any meaningful pause in the rally. But now, I mean, we're just approached a 50-day moving average. I don't have it up here, but like the interesting part that for me will be, will it be bought on dip on Monday?
Yeah, I don't know, Patrick, because it was definitely thin. It had an air or a feel. When I think about today's action, it reminded me of that December 24, 2018 decline. If you remember back then, we had this big decline, and then we got in there Christmas Eve for a half day, and the selling was just vicious and continued and continued and continued and continued. And we went out at the lows, and then I think later that day, Powell finally flipped and succumbed to the we're a long way from neutral, and he walked that back. And that's what it felt like to me. It felt like there was people demanding liquidity at a time they really shouldn't be demanding liquidity, and it just perpetuated itself. And it really was driven by oil. And that was the one that you need to, when you watched the charts and you watched how it was trading, Patrick, it was oil, and there was no bounce. Nothing. They kept selling it and selling it and selling it and selling it, Patrick.
Well, listen, we're going to pull up the oil chart in a second. Now, let's finish talking equities before we go to the commodities, because we're going to pull up the chart on that in a second. But what I wanted to highlight, okay, so, S&P and NASDAQ down just around 2%, get a little bit more or less on that. But you know what ate it? The freaking small caps just got devastated on the downside. Like it was one huge drop, and down $8+ on the downside, and this one disproportionately. And I think you just touched on it, because obviously things like energy stocks and a lot of the middle America stocks that might be affected by a coronavirus thing, airlines and other things are all sort of sometimes basket into this index, and so this disproportionately ate it.
The other thing about it is that, Patrick, if we did go back into a lockdown type trade, and I'm not saying we were going into lockdown, but I'm saying the market priced an increasing chance of that occurring. If you remember what the lockdown trade was, it was buy NASDAQ, sell small caps.
Yeah.
And buy Amazon. And for example, pull up Amazon. Amazon, I think, at one point was up today, if I remember right.
Well, that I wonder whether what's it called, Peloton.
Yeah, well, no, but Peloton's having some other problems, but Amazon's a better one to watch. And I think if you look at Costco as well, Costco went bid. So let's just start with Amazon. And I'm pretty sure it was up at one point today. Maybe it closed.
It closed down.
If you can pull up the like minute chart or whatever it is.
Yeah, it started the day. Here.
There you go. Like it had a.
No, so this is sorry. No. I'm looking at the wrong chart here. Hold on.
Patrick's just.
I'm just learning how to drive. Let's look at the 1 month chart. No, that, you know what? I don't have the daily already, but
anyways, I think at one point it was up, and then if you pull up Costco as well, Costco was another one, and I think it's actually up on the day. And you saw some of the return of the stay-at-home trade. And yes, you would think that Peloton would be one of them, but unfortunately, Peloton is suffering from terrible fundamentals.
Yeah. Costco ended
and I think
reversing.
Costco gave it up by the end of the day.
Yeah.
That was the problem. We did have this big kind of rally midday, and then we had a terrible close, Patrick. I know you weren't there and you weren't watching the markets closely, but it was just an ugly, ugly close.
But the one thing that I was observing over the last couple of weeks was the divergence in breadth. There was just in the last 2 weeks less and less stocks participating, right? And the interesting thing is, like, Here, I just have like the percentage of stocks that are above their 50-day moving averages. But you can see like we peaked out in early November near 75%, and we were down to like 50% of stocks above their 50-day moving averages. In other words, even though the stock market and was pressing along its highs on the S&P, NASDAQ was making new highs, and yet half of the stocks were eating it. And the breadth was just narrowing and narrowing, and maybe that was the canary in the coal mine of the fact that this kind of a correction was overdue.
The other thing I would like to suggest, Patrick, is that if you've been watching the trading over the past week or two, it's felt like somebody big was selling. Yes, we were grinding higher and moving around, but there was some days that all of a sudden we got selling into the European close or selling into the close that you weren't expecting. And I feel like there's been a big order in the market. There's been a distribution, as you would like to say with all your technical terms. And this has been going on for a little while now.
Right. It's interesting, but okay. But let's talk commodities now, and let's just go right to the big kahuna, because this drop on crude oil was ridiculous. Like, we haven't had this kind of a one-day down day in years. Like
and actually, Patrick, before we start talking about crude, I forgot to tell you, I believe, and I could be wrong, but I believe this was the largest decline on this half session that for between Thanksgiving and the weekend that we've ever had.
Yeah,
which itself is kind of shocking and interesting. Because it's not something you'd expect.
Well, you know what though, the interesting part about the way the markets have been evolving with the growth of the internet and access to information is people's response mechanisms are almost instantaneous. It's like the moment anyone sees something turning, the impulse to feel like you need to act is almost instantaneous. It creates that volatility in the market, both to the upside and downside, where the response mechanism was almost instantaneous. And
I would argue, Patrick, maybe also that is a result of more options being bought.
It could. That's going to contribute to it. That's going to contribute to it, 100%. Yeah. But I also think though that everyone's got their smartphones and they're watching the market, and every time the market is doing something big, they feel like they need to do something. It's like an emotional trader response where, holy shit, the market's moving, I got to do something. And if you're long too much, you're just going to add to the selling. And like this was literally just one big liquidity event, right? Like it's.
Yeah, so that's that is one of the ugliest looking candles in crude oil in ages.
Yeah, like I mean, you have to go back to like the crash itself that took a negative to get a candle of anything that's similar. Like,
so I have a question: are the far right people not the far right, but the people that were giving Brandon a hard time about his SPR release? What are they going to say now?
I don't know. I don't know, but all I know,
Patrick ducking that.
I'm just not. Exactly.
I'm
not. I don't feel like that. I'm in the position to want to voice a public opinion on something of that nature. But with that said, wow, it blew through all of its previous highs. It blew through fib zones. It was an oil crash. There's no other way to put it. It was.
Yeah, you're correct. It was an oil crash.
Like and what's interesting, like, is that, a lot of my buy on dip zones in crude oil were in the mid to low 70s. So the question is that has this somehow is it just going to be a liquidity event, and we're going to find Monday morning we're back to $72, and the market is stabilizing, $4 or $5 rebound on the upside? Or is this now going to spur a chain reaction that is just one monstrous margin call? And could that wipe it all the way back down to the summer lows? It's going to be worth watching one way or another. Intuitively, I want to buy the dip to fade it. But it's going to be something to watch early Monday morning to see whether that develops, right?
I don't think a grind down to, I don't know if summer lows is where we're headed,
Well,
but
summer
I
lows are like, I mean, there was a summer low around 65, and then there was that really, 2-3 day drop down towards 60.
let's put it this way, Patrick. How many times have you seen a big, huge candle like that, and that ends up being the low? Rarely. Like what? If we got to bounce back,
if it was a capitulation, we could be above 75 Monday morning.
Oh, that's your.
No, I'm
high.
saying if
Like-
I'm saying if it was a capitulation, if it was a blow off, then it could. That's not my forecast,
really,
by the way. Like,
but I know, but it was the first big down day.
yeah,
It was.
but oil's been correcting
3 days
for
ago.
over a
Everyone
month.
was foaming at the mouth to buy the SPR dip.
Yeah.
And so now all of a sudden this is the first down day, and the low's going to be made then. I'd be shocked if that ends up being the low. Listen, good trader never says never. So of course it could bounce and anything could happen. We could find that this whole thing was just a liquidity demand that really shouldn't have occurred, and it's going to open at 73 and then just chug around there and head higher. That's a possibility. I'm just saying that is not typically what you see on a big candle like that.
Yeah.
At the very least, you go back down there. You probably make a new low, get everyone real excited, and then you rally from there. And that would be more typical. So if I had to guess, I'd guess we do bounce from there because it probably was a little overdone. We go, open at 70 or 71. We chug around, and then sometime next week we go back and we test those lows. That would be more typical. Would you not agree?
Yep. You know what? What? If I was a betting man, well, actually, we have
Okay, well,
we
there
have
you
a
go.
we have a bet coming.
Okay, so
up.
let's stop talking about
Let's
it.
stop
and
talking
I
about
lost again, so you can give me the bet.
I think that this has got to be the one. Like
Okay.
I think we found it. But what I wanted to touch on the fact that dollar down and gold stayed flat.
I know.
Actually,
Huge disappointment.
well, you know what?
It's almost as disappointing when I didn't become a lawyer for my mom.
Stop for a second, though. Stop for a second. When there is a liquidity event and everyone is being is just unwinding, no one's looking for something to buy. So the fact that gold didn't sell when the vast majority of everything went down is actually, in my mind, somewhat positive.
Well, Patrick, I need a pep talk, so I actually enjoy that, and I hope you're correct.
Right, like silver took it a little bit. I mean, that's because
It's more of an industrial metal.
No, it's not. It's not even about an industrial metal. I just think that that's always a highly leveraged play among speculators, and so when things are being squeezed, it's going to always have more volatility. But it'll be interesting to see. But the gold stayed stable throughout this, and that's it'll be worth seeing whether or not gold, if everything calms down early next week. Will gold actually use that as a way of making a move on the upside? I think it's worth watching. But everything I want to just touch on, like lumber. Lumber has actually held up pretty well, but I mean it's never been correlated directly to the volatile markets. It's such there's so few traders are going that it's not going to be causing margin calls on.
One of our listeners suggested, by the way, and I didn't get a chance to follow up because my institutional trader that I reached out for never responded to my tweet. But one of our readers suggested that it might have something to do with the softwood lumber duties that the Americans are putting on the U.S. on us as Canadians.
Yeah,
and that's why it's going up. I don't know. I'm not sure. I wasn't. We should follow up and figure that out. But it is hanging in there, no doubt.
Right. And the other thing worth noting is just what's happening in the grains. Like wheat was more or less holding up along its highs, finishing a number of these moves. I was originally targeting a move only to like 840, and so when this thing blew all the way to 860, that was like it was just so bullish. But wheat succumbed to the rest of the market, right? Like everything sold. And so a little bit of a correction coming in here, but it's still actually a very strong trend. Lots, and it'll be interesting to see whether that the grains get bought on dip. The grains in general have been looking more positive than the other commodities. A lot of the other commodity spaces have generally been correcting. And it's really interesting that all of the grains generally looked like they were either already well established trends, or like in the case of corn and wheat, they were just starting to turn up. Like
well, Patrick, I think that can be explained by the fertilizer problem. I wrote a piece about it, but for those that want to go check out Doomberg, who is a writer on Substack, and he actually offers a free letter. And Doomberg, who's got the greatest logo ever, by the way, the green chicken, and it's Chicken Little meets gets a Bloomberg terminal or something. He's got a great little tagline, and he wrote a piece about this a couple months back as well. But the long and short of it is that for numerous reasons, the price of fertilizer is going through the roof. And if the fertilizer is expensive, then farmers will not be able to plant as much of their crops.
Right. And that makes sense.
Go check it out, though, because I know we can't pull up a price of those fertilizers, but they literally, I can't remember. Like, imagine if the index was at 20, it's gone from 20 to 100 in the space of a month.
It's, and it comes back to that whole supply chain issue thing. Like, there are so many things. Like one of my clients is big into shipping, and he was talking about like containers that would normally ship for $3,000. He's booking them, and they don't even ask the price. It'll be like $28,000 for the container, up 1,000%, and they don't even care because they just need the product.
They just
and it's just it's amazing, and certainly that has to be. That certainly has to at least support, there's the two arguments that are commonly referenced. One is that like inflation being transitory is being the supply shocks and commodity runs are driving these numbers really high, but that it's not secular in nature because of money supply not expanding, right? And that when I hear things like this, if shipping just went up 1,000%, it's probably not going to go up another 1,000%. You're not going to go from 28,000 to 280,000 a container. And so when they already went up tenfold, odds are that we're much closer to the rate of change slowing and some sort of peak moment. It doesn't mean they can't go higher, but you have to think that at least the inflation that's being driven by this will eventually start to stall out.
Wasn't it on the cover of The Economist?
Yeah,
this week?
But that was just an inflation cover. Were they talking about it as a supply shock?
No, but Patrick, the inflation that everyone's currently worried about is all the supply side inflation.
Yeah.
So that's the one that everyone is hyperventilating about. There is, you know me, I am the biggest inflation bull out there. There is a big secular bid below, but the supply side of the inflation argument is way overdone, meaning that it was all built in there. And I completely agree with you that it hits a point where, they've already increased the price of a lot of these things, and it's not going to go up from there. And oil's a perfect example. Eventually, people figure out ways around it. So they're having trouble shipping. They're figuring out another way. They're having trouble with the oil. They figure out how to pump more, whatever it is. Not pump more, release more. And you might argue these things are all temporary in nature and that eventually it'll come back. You could well be correct. But in the meantime, all the prices go down, right? So you could sit there and complain that this is the oil was a short-term solution, which I completely agree. It was a short-term solution. And I personally wouldn't have done it. But in the meantime, oil's given up, what is it? $10.
Yeah.
That the price of your all your money from the trades are all the same color.
I remember there was a period. Tell me if I'm wrong, but there was a period where a liquidity-driven oil thing caused the price to go negative. Was that correct?
Yeah, that's right.
There must have been one of these events. Was it like minus 40? The point is that like I don't know if I want to overread into the oil move. It was a liquidity event that happened today. Like and it's the same thing. It's just all the traders got caught. Everyone was way too bullish. And the stop losses were all ripped. Margin calls were getting ripped. And I don't know whether that actually changes the bigger fundamental story. Just because traders that were over leveraged are getting wiped, I don't know whether that actually changes the fundamental stance.
In fact, Patrick, I would argue that this makes it more likely that the long-term bull market in oil will continue. The worst thing that could happen is that you get prices move up because, well, not worst thing, but in terms of if you are a true oil bull, what you don't want is a supply response from the companies.
Yeah.
And the longer it stays higher, the more likely it is that they're going to have a supply response. So now, given that we've had this move, companies are going to be like, whoa, I remember when we went negative, I'm not going to go do any CapEx. So ultimately, this is sowing the seeds for much higher prices in the future.
Right.
I think this was all Kathy Wood trying to make her $12 target get hit.
All right. What's it called? Interestingly, let's talk some bond yields.
Okay.
2-year peaked. Like at least it's coming off the high. I don't know. It's not a new downtrend. Like I don't want to imply a downtrend, but it's certainly reversed off of that. I mean, we were trading, up into it's at least a 15 basis point reversal on the short term, right? And so, do you think that? What's your take on? Should we be? Is there some potential that these yields on the short end have already peaked out?
Oh, 100%.
That's just back to your same narrative of the fact that everyone is so convinced that the stories that.
Yeah,
because you were talking, like we were talking about it before, which is the idea that they're pricing in way too many hikes, like just in the euro dollar markets and everything. It's like it's an easy trade to fade almost.
Well, it's easy now in hindsight. At the time, it was scary as all heck because you had everyone screaming about how much inflation there was and how the Fed was behind the curve, and they would have to do more, and they would have to increase the pace of the tapering. I was laughing this morning, Patrick. I was saying, how long, if this continues, before we get all those chicken little inflation hawks writing op-eds screaming that the Fed did too much? Like, because this is what happens. Everyone's all,
as soon as their stocks get hurt, it's the Fed's
yeah. We have this, and the other thing you need to remember about the difference between the market participants and the Federal Reserve. The Federal Reserve, I remember Dennis Gartman described it as a huge tanker that takes forever to slow down, takes forever to turn around, and is a big, huge lumbering vehicle.
Yeah.
But markets go and they immediately, like they're like a little speedboat zipping from one side to the other. So they'll say, okay, the Fed's going to have to raise rates. I could see 2 years from now that there's more inflation coming. So what they do is they get in their speedboat and they run out ahead of the Fed. But the trouble is the Fed takes a long time to get there. And so you get these moments where stuff gets overdone on either them anticipating too much or too little. Regardless, it can be let's just say a discrepancy between the Fed, how they actually operate, and how much the market is assuming. So the market thinks that they're going to operate at this speed, and the Fed doesn't operate at that speed. And I would argue this is one of those cases. That even if inflation had stayed, even if oil hadn't collapsed, the Federal Reserve probably wouldn't have gone as fast as the market was pricing in.
Yeah.
Because they're traders. And think about it. Patrick, when you and I get bullish, what do? We go and we just buy something. And the worst thing you could do is put a trader in charge of the Federal Reserve. Do you know how often they would, just like, you think I'm kidding about this, but literally we had Stanley Druckenmiller, who I love. I think is the smartest guy around. But if you look at what he was actually advocating for the Federal Reserve, he was advocating in late 2017 that they were way behind. It was the most irresponsible Fed ever. Then Powell comes and he raises 3 times. And all of a sudden the market gets into trouble, and Druckenmiller's turning around writing op-eds about how the Fed is blind, they don't understand, blah, 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 and they have to lower rates. So for him, his kind of reaction function is way quicker. And so if he was setting policy, the variability of those short-term rates would be much, much quicker. And that's the difference between the Federal Reserve and the markets.
Right.
Anyway, so back to your question, I think that that was peak hawkish Fed getting built in for the short run, and that from here we're going to have a lot of good carry on those trades, and that we will drift higher, but in terms of the rate over the next couple of years, but it won't be as quick as the market is priced in. So therefore, in essence, you can be long the short end of the curve.
Do you have a stance on these steepeners? I put up the 530s here.
You know me, Patrick. I'm like kind of overly in love with these things always.
Always. And but the thing is that clearly, look, the 30-year has not been pricing in inflation, and it's been the dog. And so the flattening of the curves it's most evident on the 530s. The 2s, 10s didn't really move as much, but overall, there's just been this outright flattening. But the thing is, do you think that if we have seen peaks in those short-term bonds in the 2s and 5s, is this now going to be manifest an outright steepener kicking back in?
I think so, with the only caveat being that I'm increasingly getting worried there isn't enough supply at the long end of the market for the 30-year to be a true reflection of what the market thinks the risks are to inflation over that period. And so what do I mean by that? I mean that if you're a pension plan or other sorts of entities that need to hedge long-dated liabilities, that really it's one of the few things you can own that will properly hedge is long-dated government bonds. So there's a certain amount of demand for those, and if you get a situation where the government doesn't issue enough and yet there's still this demand, we could have situations where funny things happen to that rate.
Right.
And it's almost that I'm worried there's going to be too much demand for that risk-free long-dated asset, so therefore the 30-year might trade not as cheap as I would expect, given that people will continue to buy it.
Well,
so I'm actually looking at doing this, Patrick, with swaps, because I could see a situation where the swap curve moves more than the treasury curve. And I know this is getting a little complicated, and I'm not very good at this. Like I try, but let's face it, I'm really truly an equity derivatives guy at heart. But I could see a situation where the 30-year swap spread, which would previously had been positive and then blew out in the long-term capital moments, it actually went the other way and went negative. I could see a situation where that goes back and we return to a more normal swap spread, and that goes higher. So for me, when I'm thinking about trading the steepeners, I'm starting to look for other non-government ways of expressing that view. Yeah. And Patrick, this is to some extent, this is a little bit of what you always talk about with your financial repression.
Well, for sure.
And although we're not going to get yield curve control, it's a kind of almost a subtle yield curve control.
Yeah, and what I agree with that, because I don't think the bonds are ever going to accurately reflect it. I think negative real yields is a reality of our foreseeable short term or intermediate future. I don't know about to say long term, but intermediate future. But what I am actually the most shocked by, Kev, though, is we had ridiculous inflation prints, right? Like blowing out decade levels, and all sorts of people coming out there talking secular and like standing by that this is secular inflation. And yet the memo didn't arrive at the 30-year bond yield.
They didn't listen.
They didn't listen.
Yeah, and
like,
it didn't, and to some extent, this is partly what I'm talking about. But Patrick, I'm going to push back on your idea that there were some people talking about secular, but I don't think that many really believe. There's still your, Gary Schilling, Patrick Ceresna, and the rest of you deflationists. That still is the prevailing attitude for once we get through this COVID crisis.
Yeah, I'll stand by that. Anyway,
but I don't mean you should keep going on this thought, because I agree with you, Patrick. If we have, what were the inflation prints? 8? Like it was something stupid, right?
It was something stupid like that, yeah.
So let's just say it was 8. I can't remember the exact number. If we have 8% inflation prints and the 30-year says, no big deal, what is it going to take to actually kill the 30-year?
Yeah,
right. Is that the essence of your argument?
Oh, for sure. Like this, if this kind, like honestly, what is the risk to the long bond if an 8% inflation print can't kill it?
Yeah, listen,
and the thing is that and to those kind of people like the Jeffrey Snyders of the world, they're making an argument that you need the money supply, the monetary end of it to actually drive true secular inflation, or something that deserves a bigger repricing of this. And there isn't. I think that maybe that's probably what would drive the 30-year is if we started see that there was actions like right now, like all of this kind of MMT angled stuff. Never really manifested in a fiscal that was over the top. Like, I mean, there was definitely some.
I disagree with you. I'm gonna sorry to interrupt, but I'll take the other side of that.
All right, go for it.
We had the COVID crisis. We had the biggest and quickest shock to our economic system that we've ever had. Period. And MMT went and yes, I think we did practice MMT.
Oh no, I'm not saying we didn't, but let me give you this analogy, right? Yeah. So if the economy was and money supply and all of these different things were reflected by like a level of water in a bathtub, and that's the little thing. You can, if someone punched a hole at the bottom of the bathtub and the water was just flooding out, and you're going to have an economic depression driven by this thing, and someone goes and takes 2 monstrous pails of water and dumps it at the front into the tub, and it just brings the water level back to the same level it was, it doesn't actually create inflation. They might have just done the right amount. They may have just, while I'm not denying that it was a huge move that they did, but was it enough to actually say that the bathtub was about to overflow?
But I don't think that the MMT people would ever argue with you about that. I think where the MMT people would argue with you is that traditionally people said you can't keep filling the water in.
Yeah, but that's because you're assuming when people say that, they're assuming that there isn't a hole at the bottom that the shit's draining out of.
No, I think that when you're saying that, it's because people believe that governments are constrained, just like a household is constrained. And ultimately, that's what it comes down to.
Yeah.
And so if the government believes that it's constrained, then it is constrained. Well, and it does. And this is what, we could argue about whether the government is actually constrained, whether it'll end badly. Who cares? Let's just think about whether what the government is actually doing and try to decide from there. And so if you remember back to the COVID crisis, there was not many inflationists out there. Mm-hmm. Most people thought that it was going to be overwhelmed by the 3 Ds and there was going to be deflation. And how quickly they've forgotten. And now everyone, all those deflationists that said, oh, yeah, but it's just a short-term high. And, yes, there's no doubt that it was overdone in the short run. But Patrick, do you really think that if the economy rolls over and we get sustained economic weakness, that the government isn't going to do that even like more so?
Sure. Okay. So that's that you're no, but you're saying that that's a lot of ifs that the economy weakens, right? But let's go back this way. What is the current trend of fiscal and monetary? Off of those peaks, we're contracting, right? Like and there's no mandate by for there to be accelerated government spending, is there? Am I wrong?
No, because we had too much inflation.
And
this is ultimately what I think is funny, that everyone sits around and says MMT is full of it. But MMT always told you that the constraint to a government was not a financial constraint. It was always a real resource constraint. What we're seeing here is that we have a real resource constraint, which is inflation. So I agree with you. They did too much. I will be the first one to tell you. They did too much.
Tell me right now, then what's the risk of just loading the shit up out of the long bond? Like, I mean, at this stage,
like going along the long bond?
Absolutely.
So your argument is that governments from now on, the governments are going to surprise not with more fiscal, but with less fiscal, and that on the monetary side, at the margin, we're going to become more hawkish.
No, I would be. Well, that is the trend, is it not?
Yeah, I personally actually think that a hawkish central bank is actually positive for the long end of the bond market, but I'm kind of unusual. Me and Stanley Druckenmiller also believe that quantitative easing is negative for the long end.
Like in the end, what will take the floodgates to open at the fiscal and monetary again? It will take another economic downturn. I don't want to call it.
Oh, I disagree with you there. I'll take the other side of that trade.
Really?
I think at the margin we're going to be quite surprised.
Like, why do you believe that?
Because I think that people used to get told that the government can't spend. There was lots of people that said that, if you remember back to the great financial crisis occurred, and what did the government do? The government stopped spending because Carmen Reinhardt and Rogoff, or whoever they are wrote those book, they're telling them that this is going to cause a financial crisis. And that was the common belief, was that the government spending was going to cause more of a problem. And there's still people that believe that. And there's also people in your disinflation camp that believe that they can spend for a little while, but eventually it's going to cause a misallocation of resources, and it's going to eventually end badly. Lots of different reasons that they have. But the point is, Patrick, that I think that attitude, they can't spend, is gone. And so I agree that over the short run, they're going to spend a little less because everyone's gotten nervous about inflation. But here, let's just imagine that oil goes back down to $60, $50. All of a sudden, supply, everything opens up, and we have inflation coming back. You're telling me that the government is at the first sign that the economy rolls over, they're not going to spend again?
No, I'm not saying that. But the point is that it's going to first lead to that, which is basically going to be bullish for the long bond on the interim. Like so basically up to that event. And like, for instance, I had the TLT chart up here. Under this idea, would it be a shocker if the TLT went ripping to 165, 170 to the upside? Would it? I'm not. Let's forget about it being a forecast. I'm saying, would you legitimately be shocked if the TLT was printing 165, 170?
No. Like, I get it. I hear what you're saying. I just think that over the longer run, Patrick, that the surprises will be that inflation stays higher and that people realize that these bonds are getting eroded in real terms. And so, yes, I see your trade over the short run, but I believe that over the kind of medium run, people are going to realize that bonds are not going to work because we are going to have sustained, persistent higher inflation. And it's not going to be Jack Dorsey hyperinflation types. It's just going to be higher inflation. And I really, really believe that that's coming, Patrick. And therefore, although I understand your argument of why you might want to buy bonds, I think that the next major move in bonds is down, not up, when people realize this.
Okay, but I think that this is the same thing we had when we were debating this down out in Chicago in 2018. I just think we're crossing two different.
I understand
time
what you're
frames.
saying. The time frames.
The time
we're
we're
looking at. Yeah,
I'm looking at the
get
most
it.
immediate opportunity.
I just
I'm
think
talking
that- I
a
just-
trade into the year end and into the first quarter.
Yeah, okay. And I'll be the first to say that, yes, that could very well happen. I don't think it's going to happen. And if I was going to do that, Patrick, I think that a better way to play that and to express that view would be to own the front end of the curve, not the long end. Because I think that if you do get a Federal Reserve that is aware that they don't have to taper as quick, they don't have to raise as fast, you'll get a better bang for your buck on the front end of the curve.
Well, yeah,
And
if you're
I would
leveraging
say
up with the
that if
derivative markets,
No, but even-
for retail guys that are trading the bond markets, going to those through ETFs and things like that, it's a much more.
Yeah, no, I
it's more
understand. It's
challenging.
more difficult for like the average retail
So,
trader to do it.
but
I
you
just
know-
think
you know
though
what's-
that, Patrick, it's just such a terrible trade because one of these days the market is going to wake up and they're going to realize that inflation is higher. And here I will give you a little pushback to your bathtub analogy. And this is the point that I firmly think that a lot of people have missed ever since the Great Financial Crisis. So if we think about what happened leading up to the Great Financial Crisis, the private sector took on too much debt. We had a credit creation, and it was centered in real estate, and then it was augmented with all sorts of crazy derivatives, and there was way too much private sector credit growth, and that ultimately hit a point where we couldn't put any more private sector credit growth into the system, and it started to contract. And when it started to contract, the economy contracted, and ultimately, this is what the problem that created the Great Financial Crisis is that we had private sector doing credit creation, contraction, and at the same time, the federal government decided that they were going to stop spending as well. So we had two sides; everyone was stopping to spend, and then the poor Bernanke, and I know people are going to be like, "Poor Bernanke, the guy's an idiot," but the poor Bernanke was forced to be the only game in town, and that's why he did quantitative easing in 3 different stages, and he was the only way that we were trying to save the economy. And we all know, Patrick, that actually doesn't create inflation and it barely works, but that was the only game in town.
Yeah.
Now, fast forward to today, we have a situation where we have the COVID crisis. It looks terrible. It starts to collapse, but then the government goes and fills the hole. Now, so far, I think that most of the inflation and most of the problem has been a function of the supply side, meaning that we have got less people working. We have boats and everything filled with out in the harbor and not able to be transported. There's all sorts of reasons why the supply side isn't working as well. I say that if we have a situation where we return to normal, meaning the economy, we get going, trade resumes, we get people back to work, COVID doesn't seem to be as much of a problem, the consumer balance sheet, Patrick, is in fabulous shape. Mm-hmm. Absolutely fabulous shape. I wish I had the stats. I don't have them here, but
because higher gas pump prices and higher food,
Patrick,
and everything is.
You could say all those things, but
they
you
are.
go
You're
look
right.
at their actual. But they're going to be able to spend it because their actual balance sheets haven't been better in 20 years.
Yeah, I'm not going to push back on that.
No, but 1 second. I think we could get an actual private sector boom again. I think we could get people building houses. And I know you're going to say, well, housing prices have already gone up. Yes, but we could have that go on for a long time as the millennials go on. We could have corporations, go look at the amount of cash on the corporation's balance sheets. It's also never been higher because they went out, and when we had COVID, they all went out and borrowed extra because they were worried about it. So the amount of cash on their balance sheets has never been higher. Now, if you think about the trend towards deglobalization, what does that mean? That means that we're going to have a lot more factories and things move back into the States or North America. So that also means that the private sector is going to be borrowing, taking out money, and spending it in the real economy. So whereas you believe that the bathtub is never going to go up in terms of,
I never said that.
I
was using that analogy of the
I wrote this up and I talked about there being two taps for the bathtub and the sink. I used a sink, but we can call it a bathtub. The one tap is the government, which can spend money into existence.
Right.
And that we agree on, and everyone understands now that we've gone through this. The other tap is for private sector to create it and to basically loan it into existence. When a person goes out and takes out a loan to build, to buy a house, that money is being created. And so this whole side, everyone, because ever since 2008, that private sector credit creation side has been just, neutered. And there's been absolutely none of it. And it's been so tough to get going that we've all assumed it doesn't work. And I think that when we finally get onto the other side of this COVID and when we put all of the problems behind us, we're going to be surprised because of the better balance sheets of both the private sector individuals and the private sector corporations. We're going to be surprised at how much that side of the equation goes. And that's ultimately why I believe we're going to have much higher inflation.
Oh, there you go.
Because you'll find your money supply will go up for real reasons as opposed to.
Well, I mean, I think that's definitely the thing to watch, right? Because that goes to the arguments that the Jeffrey Snyders of the world are talking about. They want to see that uptick, and you're just making the argument what could be the underpinning drivers of when it does start to uptick, what will be behind it, right?
And the only pushback that I will say is that until we get that uptick on the private sector side, the government can fill the bathtub with whatever water is needed. And yes, they might get nervous about it every now and then, but that the attitude about filling the bathtub has definitely changed.
Yeah. So I want to move on to just touching on credit spreads. And one of the things we observed over the last couple of weeks was that while junk bonds were weakening on the ETF side, it was in reaction to the 2 and 5 year yields, because junk bonds are generally lower duration and have some degree of correlation, and that the credit spreads themselves were still actually holding near multi-year and multi-decade lows. Interesting that today with this little jiggle in the markets, we're starting to kind of approach the top end of the range. I don't want to call it a breakout, and I don't want to use too thick of a crayon when I'm drawing this line. But it'll be interesting to see whether credit risk starts to actually manifest here. Now, again, I wouldn't call it a breakout. I wouldn't say it's happening, but it's an interesting moment. It's sort of, we've seen on a lot of different securities when they're at a key line, and when the line breaks, then the thing accelerates. And so the question is, are we going to see credit risk start to manifest itself here?
I can report back to you. I talked to one of my fellows that was saying that the credit guys were getting, it was trading terribly today. Meaning that it was for sale and spreads were widening, and it was real. And whether it'll continue into next week, who knows? But it wasn't just a bad tick. There was some real selling in that in credit.
Yeah. A couple quick things, and then we'll move on. I wanted to just touch on that ARC did break to a lower low, and Cathie Wood's fund is still under quite a bit of pressure. It really looks like her little universe and her narrative has really lost all momentum. It's like, I mean, when Tesla is sort of holding, what was holding up, and that couldn't even keep her fund afloat. That's not a good sign, right?
Yeah, I actually wrote a piece this week, Patrick, about year-end tax selling candidates. So I went and created a little bit of a screen and tried to figure out how to rank them. And I went through them, and In Canada, it was quite obvious that there was a theme. The two that were for sale that seemed to be good candidates were pot stocks and gold miners and silver miners. But in the U.S., there didn't seem to be a theme. It was kind of all over the map until I started looking a little closer. And Patrick, I can't tell you how many of them were Kathy names. Yeah. There are so many of them that when you go look at all the different potential tax loss year-end bounces that are them. And so my conclusion to that, Patrick, was that you should be thinking about if you're using it as a short, her underperformance might be coming to a close over the next week or two. Because I think that these things are going to bounce, and they often bounce before the year end.
Oh, right. That's an interesting. That's a.
Yeah, so that was how I came to the conclusion. So in the past, yes, it's been a terrible performer. A lot of people have been using it. It's been the greatest short on the board, no doubt about it. I was short, and I brought it all in, and I think you'd be better off if you're short. And here's an idea for something to think about that I didn't write, but it's kind of the reciprocal of the idea of there's all the stocks that are for sale because they've done so poorly, and that people are going to get them off the sheets. But what about the stocks that have done so well that nobody wants to trigger a gain for in this year?
You think? Yeah, that's an interesting idea.
So right. So and then what is that? That's basically FANG, right?
Yeah.
And so it's the big nat Qs. So I suspect that it wouldn't surprise me if when we flip a year to 2022.
You just think it's that simple, eh? It's just you think this is all just tax strategy? Like I'm not trying to discredit it.
Yeah,
it's certainly an influence.
Listen, I'm just saying that at the margin that these are factors that influence it. I don't think it's the only
precipitating factors like that are.
Yeah, and listen, there's no doubt there's a million other things, but all you can do is try to figure out factors that are affecting it. And I do think it's that, and I do think that if you're sitting there and you're, let's just say Tesla. You're sitting on a big win. You've owned it for the last 5 years, and you're like, I don't want to take the tax, win this year. I'll wait till New Year. How many people are saying that with those big fangs? And I'll tell you something else that I recently read about. One of the smartest guys I know. He's just a real student of the market. I've been trying to get him on the show. I don't know if I'll ever get him, but he's a real student of the market, and he's just dogged with his research and going through things, and he's super disciplined, super nice guy. Anyways, he goes and reads all the 13 Ds, and after reading these latest rounds, he came to me just without even me prompting him. He said, I can't tell you the amount of hedge funds that are still long all these fangs and buying more. And that was, he definitely noticed it was a huge overweight and it was a huge bet they have. So to me, Patrick, it feels like oil did a week ago. Everyone's long. It's all worked. It feels great. And it's that way until it doesn't, right? There hits a point where something triggers, just like the SPR and then this variant, a couple of things come to do, and next thing you know, they go for sale. And I suspect that'll be the case here. And I think one of the triggers might be the year end. I don't know, just tossing it out there.
All right. I think that's where we'll wrap it up for this.
For this talking charts.
Is there something else that you wanted to touch on? Or
no, that's good. I like it. Let's go on to the next one here.
All right. Let's talk skin in the game, Kev.
So I lost again. Yeah. But having said that, I did want the other side of the bet on this one.
Yeah.
So it's I'm like
you tried to trap me, but the thing is you know what? It's not that I actually I remain bullish the U.S. dollar, right? Like it's just whenever a market is so overstretched, it's like betting for some sort of mean reversion is an easy side to take, especially when you went underneath the price.
So it was my greed. That was the problem.
Yeah, I think so. So just to kind of remind everyone, we were betting on the Euro USD at the 112.50 level, and it was an over under, and obviously I had the right to pick. So went over. What did we bet? It was a burger bet, right?
Yeah. So if I had gone just straight up or down, you would have chosen down.
No.
Oh,
No,
okay.
you know what? I thought
It was poorly constructed from day one.
yeah. But you
Okay.
know what?
Well,
But we're going right back here, buddy. We're going.
Okay, well, let me tell everyone about the game.
Yeah.
Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and the currency for the wagers is as follows. A Duke and Duke, which is a crisp $1 American bill, or a Canadian one, because Patrick says he still has those bills. I have yet to see it, but I'm looking forward to it. A pint of beer, a burger bet, a pitcher, a case of beer, a bottle of wine. Patrick has outlawed all the boxes. No box wines allowed. And the steak dinner, Patrick is allowed to settle that in moose if he ever loses. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and this is the important part. There will be no netting of positions.
And
by the way, actually, we've talked about a lot of these things about how we were going to have the big, huge market that'll piss up. And I know it's been disappointing, and I do apologize. It's not that we're not going to do it, but what's happened right now in Europe is exactly why we've been hesitant to book it. Because all of a sudden people are going to get stuck and people aren't going to happen. And so I think, though, Patrick, we're going to book it for the spring, no matter what, right?
Right.
And even if it's just Canadians, that's so be it.
Right. Let's do it.
Okay, so everyone, just so you know, it is happening in the spring. We will book it, and we will give everyone a date. And I really love a lot of people have reached out and say they want to come from all over the world. So I'd like to give everyone a long, long time so they make sure they can book it, and it will happen. It's going to happen in the spring, no matter what. No matter what, Patrick. Even if it's just me, you, Lena, and 4 other Torontonians, we're doing it.
All right. Sounds like
Okay.
a plan. So let's make a bet.
Okay, so what do you got for me?
Well, we're going back to crude.
Okay.
All right.
Crude is rude.
I'm just going to give you next week, one touch 72.
Okay, on which contract?
We're looking at the Jan. 2000.
Oh, I'll take that. Bought from you.
So you'll take it that it will touch?
Yeah.
Okay.
100%.
All right. Damn it.
I guess you wanted something else because now you're not going to bet very high, are you?
Well, I don't know. What are you suggesting?
Well, I'd like to go a steak dinner, but
No.
okay.
Like you were like freaking talking that it's going to continue down and all this shit.
Yeah, but
and
we
like
just had
you're like an eager
we just had
beaver
like a
throwing
$10
like
yeah,
a
but we just
steak
had
down
like-
on this.
But we just had what, a $10 move?
Forget it. You know what? Forget it. You want a steak? I'll freaking bet you a steak. Let's do
Okay,
this.
done. All right.
You know what? It's gonna be moose. I'm gonna serve you up a moose steak. This is fine. Like,
All right.
It's,
Okay. Well, you're on. That's awesome. Now watch it. Just like. Watch.
by the way,
You know what's gonna happen now, Patrick?
I actually was believing you were gonna bet the opposite. So like
No,
I was prepared to take the touch to 72.
Okay, so
but you know what?
I've
I'm
just
gonna
done.
be a
I've
sport.
just done because listen, I haven't won a steak bet in the last 3 or 4. Actually, I might have never won a steak. No, I won some steak early on. I won some steak. Watch this now. We're gonna wake up. What did we close? 68 today.
Yeah.
We're gonna wake up. It's gonna gap down to 62 and just keep going. I've just goochered oil for everyone. And
Yeah,
listen,
you know what? Send the hate
ugly,
mail to
Yeah, you
Kevin
can
at
send-
themacrotourist.com. It's his fault. He goochered it.
It is fine. Okay, so we're on 72, one touch.
Yeah.
Oh, that's awesome. That's fun. Jan contract.
I'm accepting that it's probably I'm going to lose, but let's see how it goes. I'm not going to say
It's because you have some extra moose meat.
All right.
Okay.
It's time for No Stupid Questions. It's Lena's time to
Did you almost forget my name?
Yeah, Selena.
Selena.
Welcome, Selena.
Okay, so first question here. Howdy, Huddle. You talked about chaos in pricing the 2-year U.S. Treasury note, and since then it seemed like the bond market is still roiled. For instance, I keep reading about tailing auctions. Can you explain what that is? Why is the when issued market mispricing new treasuries? Thanks for a great show. I'm so glad Morris started a podcast.
Oh, I think we all are glad that Morris started a podcast. It's awesome. Him and Liam, they're funny. I actually gave him shit the other day because I said I usually listen to these 2 other characters at Sunday night, nothing to do with markets, and I chose them because I like to get to sleep. I go to sleep with the podcast. And so I decided to move over to Morris, and I said, I got a bone to pick with you, Morris. I'm starting to listen to you on Sunday nights, and I'm not sleeping because I'm sitting up laughing and giggling like a school kid. Okay, so let's talk about auctions. For those who are really interested in this subject, we had Guy Labat. How do I say that? Did I say it? Guy? No, it's Guy. I'm saying it like a French Canadian. It's Guy. Guy Labat from Janny was on, and you can go to that, and we actually asked him all about this, but I will do my best to explain it, okay? When we have an auction of securities, it will be, let's say they're doing, did he give the 2 year? Okay, so we'll talk about the 2 years. So the government will go and say, we're going to issue $1 billion of 2 year notes. And what happens is there's an actual auction where the dealers put all their bids, and the government, the Treasury figures out to sell those $1 billion of securities based upon those bids, what the clearing price would be. Now, before we go to the actual auction where a clearing price is established, there is a when issued market, meaning that you can trade the 2 year Treasury note or whatever they're auctioning that is yet to be created. And so you're trading that based upon yield. And I do believe it trades on a yield basis as opposed to a price basis, but I could be wrong. So that's going back and forth. And what that enables the dealers to do is to kind of make a little bit of a price discovery to figure out where they should bid and how it should work and where it should trade. So when you hear about an auction tailing, what that is it's the difference between the when issued price right before the auction and the clearing price. And what that means generally, if there's a big tail, meaning that let's say the 2 year was trading at 60 basis points, and then all of a sudden the 2 year auction occurs at 62 basis points, that'd be a 2 basis point tail. It means that to sell all the securities, there wasn't enough bids, and the government had to sell them at a lower price, higher yield. And that is what a tail is. And it's almost a way of thinking about it is how much demand was there in the actual auction compared to what dealers were expecting in the when issued market. You got anything to add, Patrick, or do you think I did?
No, I think you did a good job. Let's move to the next one.
All right, second question. Love the show. After your interview with Jack Schwager, I read the Wizard's book and came away with an obvious recommendation. Keep a trading journal. Several wizards recommended journaling in addition to notes about each position, things like mindset, investing plan, and tracking emotions. This has improved my process. Some of these recommendations are abstract, though. My journaling has improved my mindset, but is a little bit sporadic. I'm wondering what you do. How strict of a format do you use for your journal? Any key things you write about for each trade? Any key things you write about each day, week, month, quarter, or year? Any other recommendations for tightening up my practice of keeping a journal? Thanks again.
Well, I'll just start because I know you're going to definitely add on this. But the one thing I want to highlight is it's not like there's this one magic way to journal, and if you figure it out, you journal better than everyone else. Like what happens is that every trader has a different personality, different objectives, different styles. And especially some traders are tracking shitloads of positions. Other traders only have a few positions on, and they lose track of their investment themes, what they were feeling, what their objectives were. And so each one has to stylize a journal to the style of trading that they do. And so it's always going to be somewhat unique. But the one thing that I personally like to use journaling for is keeping me accountable for what I intended to do from the get-go. A perfect example was we issued a trade on Apple, and when it went ripping higher the other week, the temptation for turning it into a long-term position because it was working for you And then it's like I go back. It's like, no, this is a short-term trade. We were looking for this clip, and I clipped it along the highs. If I held it by kind of just intuitively, just based on emotions, changing the entire trade plan and what your objective was, without the journal, you almost just make shit up as you go. It's sort of a way of keeping yourself accountable. Does that make sense? Like.
I think it's great, and I would agree. I would also counsel. I remember Brent Donnelly we had on our show, and he said that people are very good and disciplined about things when things are going really well or really badly. And I was like, oh yeah, that makes like sense. And it's actually discipline breaks down in the middle. And maybe on journaling it's be the opposite. I'm not sure, but one of the things is it's important to remember discipline, discipline, discipline. It doesn't matter what you're doing, just make sure you do it consistently. And I wish I could tell you all sorts of super secrets that we do that would make the big huge breakthrough. But Patrick's spot on correct. It's what works for you, and you need to figure out what's important for you. And the other thing, I guess one of the things I might say is go back and read them. Don't just think because you've written them that you never should read them. You should go back. You should go back and make sure that you read them, think about them, think about how you change, remind yourself of different beliefs that you had, and it might trigger things. But listen, I think it's great that you're doing that, and I would highly recommend everyone to journal as much as they can.
There you go. Speaking of the two people we mentioned earlier.
Oh, yeah, that's so funny.
So the last question here. Hi, Huddle Gang. Absolutely love the show. Morris Sachs, Brent Donnelly, and Cuppy are just wells of knowledge and so easy to listen to. Thank you all for what you bring to our ears each week. It's really appreciated and looked forward to. Anyways, enough with all that sappy crap and on to my stupid question for the week. I keep hearing about this on that show that Patrick cheats on Kevin with, but I haven't really heard a good explanation of why it is a bad thing. But what is wrong?
Oh, it's not. Well, stop for a second. It's not a bad thing. It's just I'm cheating. It's not my.
Oh no! I think he's saying by.
Let me just finish reading.
Okay.
Yeah, Patrick's just trying to justify his cheating.
Oh yeah.
He's what he's asking you.
Okay, so I misread. Okay, yes. I misheard. Okay.
But what is wrong with an economic melt-up? It seems like there are new highs every week and therefore a lot of money to be made, especially as things continue to, quote-unquote, melt up. What would be some signals that this melt-up is cooling off, and how best should a small retail investor begin to position and prepare for the inevitable downturn? Thank you all. Looking forward to braving these economic times with you all.
Now, clearly, this question was submitted before today.
Well... but I do think that's a great point, because you'll hear lots of people get upset about the economy running hot, the stock market running hot, and they think there's so much negative involved with it. I guess one thing you might say in terms of the stock market running too hot is that if you allow bubbles to create, then the inevitable bursting of them creates hardships that are difficult to clean up. So, for example, after the great financial crisis, when Powell took over as the Fed chair, he actually went and tried to get out ahead and raise rates tighter. And if you remember back to his comments back then, he was very much centered in the idea that he said, when these things burst, it's way worse. So therefore, we should make sure they never grow too big in the first place. And this was in the opposite kind of mantra of Alan Greenspan, who said it's always difficult to tell when a market is in a bubble, and it doesn't really matter because you can just clean it up afterwards. And if you're thinking about why some people believe that there's something inherently wrong with a melt up, I would say that that's their reasoning, and I think that's up in the air about debate. But I will say something else, that too often people aren't willing to allow economic melt ups to occur enough. And for example, we had situations where labor was winning and actually getting rate hikes. And not rate hikes, sorry, I'm so used to talking about interest rates, wage hikes. And so if we look back to the last year, like how many times did you hear about, the minimum wage is going up here, or all of a sudden this restaurant has to pay more for labor. And this was viewed as something terrible. And it always kind of astounds me, because isn't that what markets are all about? Isn't it always, if there's not enough of something, it should be priced higher? And isn't that a good thing, that there was so much demand for jobs out there that people were able to make more? And so I push back really hard to all the traditional Wall Street / Bay Street / City of London folks that think that this is a bad thing. And the reason that they generally think that is because we're in capital markets, and capital has been winning over labor for a long time. So if we don't have a situation where there is always a certain amount of unemployment in the system, we will inevitably have wage hikes. And this is arguably what the Federal Reserve was trying to change when they went to flexible average inflation targeting. Because if you think about it in terms of when the Fed previously hiked, the moment that unemployment went to a certain level, they assumed that wage or labor was going to start winning. And so therefore they had to slow the economy. So when the people that needed it most, the last ones to get a job, were about to start to be able to get a job, the Fed would slow down the economy. And that is, in essence, what is at the heart of the, let's just say, conflict between labor and capital. And one of the things that you need to remember when you're thinking about how this all plays out is, you might have your opinion about which one should win and what their fair rates are and how it should all work. But if you find a Federal Reserve that is willing to change that relationship and is willing to let things run hotter and allow the reaction function to be later, meaning that in the past they might hike when unemployment was 5%, and now all of a sudden they're going to hike when it's 3%, it changes everything.
Right. So now I think you went a little bit on a tangent, like a little farther. So I want to bring it back to part of the question. So the question was, what would be some of the signals that the melt up is cooling off, and what would be the best for a smaller retail investor to begin to position or prepare for an inevitable downturn?
Just to push back, Patrick, I only answered what is wrong with an economic model.
Okay. All right, fair enough.
Okay, so now you're going to answer the second part.
Sure, I'll answer. Well, so generally, now there are. It's not just limited to two ways a market tops, but the two very commonly observed ways a market tops is either it blows off, right, which we call the Eiffel Tower, which is like it just goes parabolic to the upside, and then just gravity takes over, it just ran out of momentum, and the mean reverts in a monstrous way. But the other way that markets top is they just become divergent, and they lose all momentum, and they just kind of crawl, and then inevitably just roll over and die. Is two ways. And a good example of that is if you kind of look back to 1999, the NASDAQ went parabolic, but the S&P kind of stayed flat and lost all momentum and rolled over. And it was like in the same time period, but the two markets did completely opposite setups. The point being here is that you have to sort of be watching, is there something evident that is diverging in some way that is showing signs that we're imminent on that? But then how does an investor prepare? Well, the one thing that is common is that if retail investors are quick to go to cash, and then they can't get back into the market easily because they're chasing and trying to over-market time. Sometimes you end up missing really good bull runs because you're just on the sideline waiting for this inevitable correction. One of my favorite ways is to just trailer hedges, right? Like you put on some sort of a protective way of having a downside risk. That way you can keep pressing the long trade up in a melt up environment and still have some way to blunt the reversal if you get caught in it. And that's my favorite way of doing it. Do you have something that you use?
Now you've converted me on that one, so I'm with you.
Okay. Well, there you go.
Well, there you go.
You know,
so, Lena, tell people where they can find the whole 9 yards about the no stupid questions, just stupid answers.
That's right. So if you want any more stupid answers from Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Nice.
Okay.
Well,
all right, folks. Thanks for tuning into the Market Huddle. We appreciate
that was a short one, right?
I know, Patrick. Let me just do this outro, and then you can talk all you want in the end. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give Lena a follow at the Market Huddle on Twitter, and check out her merch store. Lena, what's the? How do they find it again?
www.markethuddlemerch.com.
There you go. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. Actually, they can listen to those as long as we upload it correctly, which we had a little trouble last time, but we got it all fixed up. A lot of people watch on YouTube to see all of our charts and visuals, and while you're there, please like and subscribe to get our latest content. And if you could, please rate and review us on iTunes. We really appreciate it. Patrick, where can they find you?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Ceresna. How about you, Kev? Where can they find you?
I'm at Kevin Muir on Twitter. They can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, now you can talk about what you wanted to talk about.
I forgot. I already forgot. I'm done.
Here I am thinking, oh my gosh.
He's got a memory of a goldfish.
I was like, oh my God, are we going to be able to make a long enough show? It's already been an hour and a half, so you guys have no shortage of things to talk
you know
about.
what? That's me. That's the problem. When he lets me talk, I just go. I'm usually good. I keep my mouth shut when I'm asking questions.
And you try to anyway.
I do. When we're asking questions, no. But when I'm interviewing, I keep my mouth shut. But then when someone asks me a question, I go. Okay, Patrick, tell us about your beer first of all.
Right. Okay. So, it's a very Guinness style beer, and it's delicious. I love Guinness, and I love this beer. This is fantastic.
Can you tell us the name of the beer again?
Wieselburger.
Wieselburger.
I have no idea whether I pronounced that right.
Wieselburger? Maybe
something like that.
Isn't like a W?
I'm doing the North American version of it.
It sounds like Patrick is figured out, like the weasel, like a ferret.
Yeah.
And he's turned it into a burger.
Yeah.
I'm having a weasel burger. I got fed up with squirrel burger, so I'm moving up to weasel burger.
It's exactly the way it's spelled, buddy. It's
okay. So what are you giving the old weasel burger?
I'm. You know what? I really like it. I'm going to give it an 8.5.
Oh, nice. Okay.
8.5. It's you know what? I'll tell you, if this was on the store shelf right beside Guinness, I'd have a hard time picking which one I'd take if I was in the mood for one of those types of beer.
You'd probably take both.
No.
Yeah, I'd probably take both.
That is what Patrick would do. Lena,
how are you going to rate your Labatt 50?
It's always Labatt St. Gaudens. It's always a quality beer, a little bit skunky and just awesome.
It's skunky because it's been in your fridge for 2 years.
Yeah, exactly. Lena, I was watching. Patrick, I'm going to cut you out because I know you haven't watched it. But Lena, have you watched Dope Sick?
No, I've heard about this though.
Yeah, so it's about the Sackler family and the opioid kind of scandal with OxyContin.
Yeah.
It's got Michael Keaton in it, who does a terrific job. Absolutely great actor.
Oh, Michael Keaton's great.
I'm a huge fan of the show. You know what pisses me off though? They didn't drop it all at once.
Oh yeah, no, I'm
what's
probably
with this trend?
I'm gonna
What's
wait.
with this trend of making like the old school? Like I guess maybe it's because they're also showing it somewhere else, like on the traditional
maybe.
network.
Is it on Netflix?
But
where is this on?
I know it's on Apple TV. Yeah, I think it's on Apple TV. But you know what? The Americans have it. You know what's really weird, Lena? The Americans get it on Sunday night, and we get it on Wednesday.
Before or after?
I'm pretty sure after.
Yeah, well.
it's like most things in Canada come after.
Probably half the
like-
show's probably cut out. You know, they were probably looking
No,
at it and was like,
no,
no,
so,
we're gonna cut this part out.
Anyway, no. But anyways, you should watch it.
I've heard good things.
It's great.
I've heard really good
Yeah.
things about it. So.
We really like it, and you should wait for them all so you can binge watch
Yeah,
them.
I stopped watching Succession because I was like, okay, I need to binge. So
Yeah, I know that there's another one that they do that. But that's HBO. At least you understand that.
Yeah.
That's a traditional. This is Apple. But I think Apple did the same with the morning show. Did you watch that,
no,
by the way?
I don't know. Something about it was like, yeah, I'm okay. I pass. I don't know.
I watched it. I thought it was, I don't know. I thought it was, there's parts of it I really liked, and there's parts of it I kind of, whatever. It's a little, it's not about Hollywood, it's about New York, but it feels a little like just actors.
Oh.
It feels a little, anyways.
Yeah, that's a pass for me.
Yeah. You're already,
But-
what are you watching? Anything new and good?
We watched all of Ghostbusters that were out there.
You had a
including-
Ghostbusters marathon?
Yeah, including I guess the newest one is both just a female Ghostbusters.
No, but there's a new
There's
one.
a new
And I
one
don't
that's
know-
coming out, I think.
Oh, okay.
That
so
one's
you were
not
just
out yet.
getting in prepared because you felt like you needed to know the plots of the previous ones to
Oh
watch
no,
the
it was
new
just
one.
kind of like I don't know how it happened. We just decided to watch one of the
Sounds-
movies that we haven't seen in a
Sounds
very
like you were
long time.
desperate for shows.
We
like
definitely
you're running
were.
out
No
of things.
way. Are you kidding? Ghostbusters is an unbelievably great show. By far the best character in there, Rick Moranis.
It is
great.
true.
Oh, he is awesome. When he's the accountant and he invites them up and he's like, "Oh, this is Fred and Susan. They just declared bankruptcy." And blah, blah, blah. And then
We
he
have a
goes,
friend
"This
like
is
that, so
really that tells you all
Just like,
those things."
Shut up already.
This is Fred. I mean, this is Joanne. She's doing this,
Yeah.
and then he throws the coat onto the Hades dog or whatever,
Yeah.
and then he's like, "All right, who brought the dog?" Eh? He does a little bit of Bob and Doug in there.
So
no, yeah, he's
Ghostbusters
awesome.
series, we watched the whole thing, and then I actually just started watching, I just finished watching the season 2 of Tiger King.
Oh, see, I didn't ever watch that because I feel bad because aren't the animals abused?
The second season is not so much about like animal abuse, but it's all the other things that happen because of the guy being convicted and more legal
Yeah.
things, and it's kind of unbelievable when you watch the show.
Well, I'm pretty sure it's probably not that surprising, right? Like, aren't they just crazed? Like, isn't it like some like in the hillbilly
It's
part? And like,
yeah, you
no
just have
offense
to
to
watch
hillbillies.
it. I don't know how else to describe it. There's a lot of things in there that I don't really agree with, but it's definitely
Okay.
still an interesting watch.
I'm not going to watch it, so that'll be one that I'm just going to skip. I don't know why. That's one of the ones that left a bad taste in my mouth. I'm like, I'm not going to support that. But that's okay. That's what makes a market.
Remember we talked
yeah.
about Ryan Reynolds last week?
Okay.
Well, you're still thinking about him, aren't you?
Well, I just watched a movie with him in it a couple of days ago.
Oh, my daughter told me it was terrible.
Which movie?
Whatever his new one is.
It's called Red Notice. It's got Dwayne Johnson in it also.
Yeah, and it got like 42 tomatoes.
It's not a good movie. It's not an Oscar
Yeah.
winner, but you got The Rock and Ryan Reynolds.
Yeah, so
What can
like,
go wrong?
Were their shirts off? For half
A
of it?
lot
'Cause,
could
like,
clearly
that's-
go wrong.
Yeah.
I can't remember if
I
they
wonder-
had the shirts off, but they were very tight shirts.
Oh, okay. So that's basically that's fine. It's again what
It
makes
was
a market.
watchable. It was
I'm gonna skip
watchable. Like it wasn't great, but it wasn't like oh my god.
So
I'm
if they
gonna
were
turn it
wearing
off.
baggy clothing, would it have been as watchable?
Yeah, I like their humor. I like their humor. Yeah. So,
Oh, well, and it's got Gal Gadot,
yeah.
right?
So
Yeah.
it's
It got terrible tomatoes,
Ah,
and I'm
it's-
you know me, I'm very strict with the tomatoes.
Yeah.
I'll watch. I watch literally if something's 90 or above tomatoes, I don't care what it is. It could be the most boring sounding, like
You'll watch
I
it.
don't know. Let's just imagine, poetry reading in another language, and if it has 92 or 94 tomatoes, I'm in. It doesn't matter.
and then Luke and I play this game. He likes to play this game where, hey, let's watch this movie that we've never heard of. I'm a kind of a person, once I start watching something, I have to finish it till the end, regardless.
Yeah.
He's like, let's put it on. And then you count down 5, 4, 3, 2, 1, and he's out. So I'm left with watching whatever movie we put on, even if it's terrible.
He plays like movie bingo and then bails
and
on
he
you.
goes, oh, let's watch this. Yeah, that's great. Like, oh, this could be interesting. Great. And then I look over 5, 10 minutes later, he's out. Out like a light.
Oh, you mean he falls asleep?
Oh, he falls asleep.
Oh, my goodness.
And then he wakes up literally at the very end, right before the credits roll. He's like, oh, was the movie good?
Yeah.
But that's actually why I don't really watch TVs and movies, because that's me. Like, I have the Luke syndrome. Like, I literally, I last
too many gummies before your movie.
My
That's
God.
Or too many beers in your case, Patrick.
Oh my.
So
anyway,
the terrible movie that I ended up ended up watching and he fell asleep to was called Gallows Walkers. It's got Wesley Snipes in it.
Isn't he in jail for tax evasion?
Oh, probably. I'm not sure, but it's from like 2012, I think.
Let's see how many tomatoes. Could it be a new low?
I don't know. It's kind of like, when Nicolas Cage went into the whole IRS thing and he was making all these
Oh my God,
movies.
this is a new low. This is a new low.
What did they give it?
This is so bad. Patrick, I'll give you both a shot at it. How many tomatoes is this thing?
Well, now you know. Tell us a lot. I'd say 12.
What about you, Lena?
I mean, after seeing it, I don't know. 12 seems pretty high to me.
Well, you know what? You're right. It is a little high. It is 11 tomatoes.
Oh, jeez.
I have never seen anything this bad. And you actually sat through it.
I mean, I was like,
poor
maybe
thing.
it'll get better.
You'll never get those 2 hours. You'll never get those 2 hours back in your life.
It's a little campy. So I was like, oh, it could be kind of funny.
Oh my God, that is the worst tomatoes I've ever seen. I didn't even know they went to 11.
It's just like the amplifier and.
That's right. I didn't know it got to 11.
So.
Oh well,
Luke
there you
1,
go. So
Lena
folks,
0. That's kind of where.
Yeah,
right?
Gallows Walkers, stay away from it.
Or go watch it and tell us how good it was.
That's right. Okay, well, anyways,
we forgot to wish. I guess Thanksgiving was yesterday for our American listeners, but happy Thanksgiving weekend for all of our listeners.
Black Friday.
Yeah,
go get in line at some.
No, but they're listening to this on Saturday, so it's just about.
Is today the shopping day?
Yeah. So enjoy your long weekend and Cyber Monday.
Oh, that's right. We get that now too, though. And do you know what's funny is that this whole thing, we actually have Black Friday kind of up here.
Yeah, I mean,
we do.
Things go on sale.
Retailers,
Yeah, because the retailers here don't want everyone driving down to the States to go shopping.
Yep.
So they need to put on the sales up here because that's what Canadians do. They get into their cars and go, an hour across the border, hit some
to buy a TV for like $100.
Exactly.
and wait in line for and then miss it. It does not seem like very much fun shopping on Black Friday.
It looks scary
I almost
to me.
pay extra. Yeah.
I don't need to save that much money that desperately. It's
yeah, and it's just
I think
crowds,
people get injured and stuff every Black Friday.
Oh yeah,
doorbusters or whatever they're called, like people waiting from right after Thanksgiving dinner and waiting outside Best Buy or whatever and trying to get the deal, like first in line. It's scary. It's dangerous.
There you go. Be careful out there, folks.
Yeah.
Okay, well, everyone, have a great weekend.
Yeah. Have a great weekend, everyone. It's a good show.
And next week we'll be back. We got our guest. You won't have to listen to Patrick and I the whole time.
So please come back.
All right.
Okay, take care.
Take care, everyone.
Bye-bye.